All right, welcome to a whole new episode of Financially Speaking with SFM. I'm Dan LaForest. This is Daniel Courson. We're both wealth advisors here at Security Financial Management. And Daniel, we like doing these shows because we like to bring education to our clients and people into the general industry, because there's so much that we have to take in consideration when we make recommendations, whether it be in investments or any other aspect of what we do.
That's absolutely right. Education is key, and so you want to be able to teach as we do things. That's the whole point of what we do. Is make sure we spread the knowledge.
So Daniel, today we're going to talk about technology. There's a lot of big technology names that people like to invest in. And, we've always preached diversification, but there are certain segments that people favor, probably a little bit too much at sometimes. But there's a lot of backstories that we have to take a look at as we make recommendations to clients that are looking at certain segments of portfolios and whatnot. And technology really drives our lives now. So it's not something that, people want to shy away from because, we were talking about off camera. You can't get into a brand new vehicle anymore without being dependent on electronics, whether it be in the dashboard or, in how things are operating. Heck, you look at some of these new refrigerators. You can actually put a grocery list on a computer on your screen, on your door, in your refrigerator. So technology plays such a vital role. But today's topic is really interesting, and we're going to dive right into it. And it's basically the Magnificent 7 or the Magnificent 24.
That's right. And these are the 7 really highest performing stocks of the past, I'd say, what's that, year and a half, you think? I even did a video on this about a year ago, pretty much a year ago this month, if I recall. And I think now you're starting to maybe you're seeing the reference of Magnificent 6, because one of those 7 has kind of fallen by the wayside a little bit, that being Tesla. But we won't get into those details too much. But basically, the Magnificent 7 is really more of a nickname. Every few years, there's some basket of stocks that gets the nickname because they are sort of outpacing the rest of the market. A few years ago, we had FANG, Facebook, Apple, Amazon, Netflix, and Google. And those 5 stocks were the leaders for a year or two of the market. And going back to 2023, you have the Magnificent 7. Now, these companies are going to be associated with big technology trends. Think artificial intelligence, cloud computing, and what you just mentioned a minute ago, high-performance computer chips. Can't get around any of that. Pretty much everything we use on a daily basis has it in it, or it was made using chips and or AI and cloud computing. Now, these 7 companies, they represent almost 30% of the S&P 500. That's a very high concentration in a small number of companies. And
when we talk about broad indexes, Daniel, is the fact that, S&P 500 is the benchmark that we try to gauge performance based on risk with a client. But obviously the NASDAQ and Dow are always in the discussion, and that NASDAQ is primarily technology.
That's correct. And because these few companies that make up such a large portion of the S&P 500, which again is not the only index, but it's the most commonly referred to benchmark. It's kind of what people gravitate to. But these high valuations have caused a lot of investors to just forego equity markets because they associate the stock market almost with these 7 stocks to a sense. However, you could also argue that yes, these are 7 stocks, but they're not as concentrated as you might think. and are they worth their high valuations? And that's something that I think would be a good talking point, because even though investors should be cautious about having too much exposure in the Mag 7, however, you could investing in companies with these high expectations can be risky.
Oh, no doubt about it.
Yeah, we've
seen trends over the years.
Markets as well.
Yeah, we've seen a lot of trends over the years. But let's dive right into this and kind of give people an idea of what we're talking about when we talk about the Magnificent Seven and the Magnificent 24. The Magnificent Seven refers to, like you said, the 7 leading U.S. companies associated with big technology trends like artificial intelligence, cloud and computing, and high performance computer chips.
That's right.
So these companies comprise almost 30% of the S&P 500. You mentioned that earlier. Compared to the past, this is a very high concentration in a small number of companies. Their high concentration, along with their high valuations, I should say, have led to some investors to kind of get away from the equity marks. You had mentioned that. But we're finding out that Magnificent Seven are not as concentrated as some people think. And they may be worth every bit of their high valuations to the Mag 7, because investing in companies with extremely high expectations can be risky. Instead of avoiding the Mag 7, we need to diversify them. And, I remember going back, Daniel, before I became a wealth advisor, I was actually a semiconductor rep. So I was very involved. And what a lot of people don't realize is, even if we look back in the 80s and 90s, almost all of electronics came from Japan. You had very few American companies, and where that transition happened was during the 90s with the Clinton administration, when he forced U.S. companies who were primary military to reduce their testing qualifications on military products, which dropped their overhead and forced them to get into commercial markets such as Lockheed Martin and also Harris Corporation.
Yeah.
So let's talk about the Magnificent 24.
Yeah, we haven't heard that one yet. The Magnificent 24 is really what you could argue that the Magnificent Seven is. So it's 7 companies, but it's really 24 different distinct business lines. And so, for example, companies evolve over time, and we're going to take Apple as an example. So think back pre-iPhones and iPads and AirPods. Let's go back to the year 2000, at the turn of the century. Apple was just a computer company. It was Apple Computers. They were known for their unique, computers and desktops. Now you could really name 5 business lines that Apple has. You got iPhones, that's probably the most popular. Wearables, the Mac computer, the MacBook, the iPads, and then you have software services. You have your streaming services, Apple Music, and so forth. And so you could say the same thing for other companies like Amazon. Is both retail, but they also have web hosting. And so you take these 7 companies and look at all their business lines, you really have 24 distinct businesses. And they have annual revenues really, above the average company in the S&P 500. So, however, yes, we just took 7 and made it 24. So that's diversification. We're spreading out our risk after all. However, you're still predominantly related to technology. Some are in some other industries, like I mentioned, Amazon has some in retail. Tesla has, they're involved in auto, although Musk says they're not an auto company.
Well, that's been a debate last couple of years. Are they an auto company? Or are they a technology company? Because of the technology. And I like the way you're explaining this, because diversification within the company, right, and what they do You mentioned Apple. Apple was the number one streaming wholesaler of music. You talked about their diversification. How about Netflix? Netflix started out with sending out DVDs of movies where you mail ordered. It was kind of like a Publishers Clearinghouse where you ordered movies to come in and you played them on a DVD player. Now they're hosting, they have their own production company. Now they're hosting the Jake Paul, Mike Tyson fight live on Netflix. So, there's so much diversification within these companies.
Yeah, and Microsoft, one of the biggest, when I was years ago, they were your default web browser many of the times, and now they're huge into cloud hosting, huge investor in artificial intelligence. So you're I get it. You're not investing in 7 things. Technically, you could say it's 24, but predominantly those 24 is still one sector, which is technology, and so there is still some risk involved, even though we just sort of created a argument for 7 companies.
Daniel, let's talk about, you mentioned high valuations before. Let's explain what a valuation is.
So valuation is what the value of that company is. And let's just say the success of these companies due to the technologies they produce has led to very high price to earnings ratios. So that means that the price of the stock is very high relative to the earnings that they are creating. So what you're paying for is essentially anticipated earnings. You're paying for expectations. And so the Magnificent 7 trade at, we'll call it 28 times next year's estimated earnings. So you're paying a premium. Now, the market is trading at a lower price to earnings ratio. I believe it's 19. It could be different, if this, depending on when this gets posted, but it's pretty much 28 now for the Max 7, 19 times for the rest of the market. So that's 493 companies that are trading much lower, and even 19 is still somewhat high.
I think that's a good point to bring up, Daniel, is typically when we're looking at valuations of stocks, the norm for value is at 20 times earnings or less.
Yeah.
And these are already trading at 28. So when we look at stocks as far as investment vehicles, we're looking at valuations. And right now, tech stocks are way outside of what we normally see as value.
That is true. But however, is the high PE ratio, PE, price to earnings, is it justifiable? Now, last year, the Mag 7 grew much faster than the rest of the 493 companies. I believe, if we're being exact, the earnings grew by 43% over the last year. What did the rest of the market do? It was 7. Huge difference. Will they continue? Analysts expect, and you can take analysts however you want to take them, but they expect these 7 companies to grow by over 25% over next year. Now, is that growth worth the higher price? It really depends. Can they continue to deliver, the expectations that they've created for themselves?
And the thing is we tell people all the time, don't fall in love with 1 or 2 stocks, because as much as they can make you smile, they can also turn on you as well. All right, but going to cautionary tales, let's talk about that, because we talked about the 1990s where we had the tech bubble, and there was a lot of excitement about new technology and new technology companies, and the IPOs were flying out and going public, but there was a lot of heartbreak in that time as well.
Correct, and if you were to take the top 7 stocks, or maybe the top 10 stocks of 2000, 2000 was sort of the peak of the tech boom. And you look at those 10 companies, and now look 24 years later, you might find what, two, maybe three at most that are still relevant today. I remember in 2000, Cisco Systems was they were the stock to be in. I remember buying shares of Cisco Systems back in 2000. They were quote the backbone of a revolutionary new technology. And
There was another company that went along with them too. They were called IBM.
Yeah, yeah. And the new technology at the time was internet.
Yeah.
That was, and so Cisco Systems was the company, along with IBM was, IBM's still around, but not at the same relevancy. But Cisco was trading at a price to earnings ratio of over 300%. And you think 28 is high, it was over 300% price to earnings, that people were just paying outrageous prices for Cisco Systems. And they have, since then, they've tripled their revenue, and they've grown their earnings per share by, goodness, I bet it's close to 2,000%. However, if you look at their stock price, it's actually declined by 33%. They lost a third of their stock price since 2000.
Right. We talk about current time. I mean, we saw Meta, the parent company for Facebook, actually decline earlier in the week at 13% one day.
Yeah.
All right, so, 7 or 24, still mostly tech, Daniel.
Before we move forward, I just want to say that you can be a great company and you can produce a good product. However, you have to keep up with the expectations that have been built into the price.
Well, let's talk about 7 or 24. It's still mostly tech, isn't it?
Yeah. So yeah, whether it's 7 or 24, it's still predominantly technology. Now you're going to have some diversification, within these, but it's still mostly, small. It's still mostly technology, large cap growth stocks. Predominantly, all of these are concentrated into the NASDAQ 100. And so it's still very concentrated as far as diversification goes. And the market as a whole, we keep using the S&P 500 as kind of an example here, but now with the growth of technology, nearly 40% of the index is comprised of technology companies. Yeah. Now, how's a good way to create some diversification? I would say if you look overseas, besides the fact of going into different market classes like mid cap and small cap, go overseas, and they're much less concentrated in technology. Europe is more of a manufacturing economy, where we're more of a service economy. So you're going to get more exposure to some traditionally cyclical sectors like industrials, financials, and consumer-driven stocks, and less towards technology like you do here in the U.S. So I'm not saying to avoid the 7. These are good companies. They create necessary products that you can't really get around using, but build around it. Make sure that, if you're going to own the S&P 500, keep in mind that almost a third of your money will be in these 7 companies. Even if it's 24 different business lines, it's still pretty much all technology.
So again, it's good to diversify, have some of that international exposure. Also, having that bond index, and a lot of people don't realize is investing in stocks is much riskier than indexes because you're depending on that one company to produce. Let's talk about the key takeaways, Daniel.
Well, I'd say the key takeaways is pay attention to the concentration of what you're investing in. Like you just mentioned with the indexes. Indexes are great. It's a great low cost, long-term investment. However, every few years, indexes tend to get very concentrated. And if you look at history may not repeat itself, but it does rhyme. Typically what follows a very concentrated year like we had last year is a broadening out of the market. We're seeing less growth in those companies and more growth in other areas of the market, such as more traditional, more of your boring industries, put it to you that way. And so by no means avoid the Mag 7 or the tech sector. I'm not saying that. I don't think you are either, but just make sure you're not too concentrated in that. And then a great way to diversify around it is to invest in some more value companies, those that are have a price closer to their earnings, and also international. And then depending on your stage of investing, some fixed income exposure as well.
And really, at this point, some of the value companies are international based on what we've seen in the last couple of years. Well, that is it for this week's episode of Financially Speaking with SFM. Again, what we're trying to do is bring the education back to you guys out there so that you understand some things behind the scenes, a lot of stuff in the news. We want to be able to clarify that a little bit. Also, check out our partners here at SFM that have the Best Advice podcast. You can check that on our YouTube page here as well. For Daniel Courson, I'm Dan LaForest, and we'll be back with a new topic and more education here on Financially Speaking.